for some few more minutes. First of all, thanks a lot everybody for taking your time out and joining for this webinar. We at Smart Wealth have been conducting various webinars on various topics, and you can also see a lot of finance related videos which we have uploaded on our YouTube channel. You can subscribe to the channel of Shreya Vaidya or Smart Wealth. So for today's talk, let me first of all welcome Mr. Sanjay Dubey. Uh, I think Sanjay is, yeah. Welcome, Sanjay. So, all of you, please join me in welcoming Mr. Sanjay Dubey. Sanjay is a certified financial planner with a 13 years plus experience in the field of financial planning and investment advisory. Uh, Sanjay comes with a rich experience in large companies like Aviva India, Future Generali, and ICICI. Uh, Sanjay is also an associate from Insurance Institute of India. So let's all welcome Sanjay for this wonderful webinar. So thanks, Sanjay, for joining.
Thanks, Mir. Thanks for inviting me for this.
Perfect. So, Sanjay, Sensex at 47,000 levels. What are your outlook about this, and how do you see the future panning out?
Mihir, over a long term, as my view always has been that over a long term market would continue to remain very positive. Short-term hiccups here and there might come, but there's huge FI liquidity, there's huge local liquidity in the market, and over a long term, expecting small hiccups here and there, over a long term market continues to remain positive.
Okay. So today, as our topic is, we are going to briefly talk about the three avenues of market-related investments or the equity-related investments. Those of you who have just joined in, our topic for today would be where we would be trying to differentiate between the three different kinds of popular kinds of equity-related investment distinctly: the equities, which is buying shares directly; the mutual fund route; and the Ulips, the unit-linked insurance plans. So, Sanjay, our guest today, would be explaining in detail about what these three products are and how it can benefit to the various kind of investors. So, Sanjay, what is your primary? How do you think we can differentiate between these three type of equity-related investment options?
My view to this question is that a lot of times our investors and people keep on trying to compare these things. We come across topics like mutual fund versus direct equity, ULIP versus mutual funds. I would say that these are not competitors, but these are brothers from the same mother. The investment avenue remains equity market. The performance broadly would remain on the fund manager. If it is direct equity, the customer himself will choose an equity and would invest. If it is a mutual fund, the performance will depend on the benchmark and the fund manager. If it is a unit linked scheme, it will depend on the product and the fund that he is choosing, and of course the kind of equity that the fund manager is choosing. So I would say that these are brothers from the same mother. It is about a choice of a product that the customer has to make, looking at the kind of cash flow that he is expecting in return, and also the kind of risk that he wants to take.
Okay. So we also have a lot of first-time investors over here in this group of audience. So can you just briefly touch upon the basics about the difference between direct equity versus managed products like mutual funds or unit-linked products? So can you just quickly touch upon the basic difference?
So just to give you a glimpse of all these three avenues of investment, I would say direct equity is where you trust your own knowledge and pick up the equity basis your understanding and your research on the stock, or basis some information or tip that you get from someone. So that is how someone should invest into does invest into a direct equity, I would strictly recommend for the first time investors to avoid this kind of investment. Rather go for a mutual fund or a unit linked route, wherein there is a professional fund manager to select this for you, and basis your risk appetite and the horizon of your investment, you can choose between both. But talking about direct equity, it is directly buying shares basis your own research and understanding. Mutual fund is of course going to the choosing a fund of which fund house, whether you want to go to, you want to go to large cap, you want to go to mid cap, you want to go to small cap, you want to go to multi cap, or basis the recommendation from a financial advisor. You can opt for a horizon. It can be as short as 1 year, it can be as long as 35, 40 years. You can choose your horizon and go for a fund that is managed by a fund manager, and you can opt for a regular investment or a one time investment the way you want to. Coming to a unit linked investment, I currently say that is the tax haven for someone who wants to invest into an equity, because in the current times that is the only place that can give you tax free returns when you are investing into an equity. Here the horizon has to be minimum 5 years. You do not have the liquidity option of taking the money after 1 year, 2 year, 3 year, 4 years. So if your horizon is less than 5 years, then ULIP is not the place for you. You should look at direct equity or a mutual fund. But if your horizon is more than 5 years, then there is one option that you should definitely explore for your long-term investment tool.
Okay, basically you mean to say direct equity is for those investors जिन्होंने अपना पैसा who know equity market, who have studied shares. It's for them, and the other two products are essentially if you want to trust somebody uh, to manage your money in a better sense. Am I right?
Perfect. Perfect.
Okay, perfect. So how would you in today's times, what kind of investor should actually look at investing in direct equity versus a ULIP and versus a mutual fund? What would be the broadly kind of investors or the type of investors who should enter these kind of products?
So, as I said, Mihir, that these are brothers from the same mother. I would not say that do one and avoid the other. Okay, I would recommend that if you have any short-term goal that you have to meet in the next 2 to 5 years, then mutual fund should be your choice of investment. And if you have another long-term goals coming after 5 years, you can choose a unit-linked kind of investment where you get a similar investment avenue, but you still get a tax advantage, and plus you are secured with life insurance. So you can opt for a unit link kind of avenue. And if you are an experienced investor and you have some surplus money, you can opt for some blue chip companies and go for a direct equity also.
Perfect, perfect. Sounds interesting. But then, what a lot of people, a lot of investors, which we come to us, are straight away saying no to ULIP kind of products because they might have had some better experience in the past. How would you kind to counter these kind of experiences which people in the past would have taken a lot of ULIP related products in early 2000s kind of. So how would you like to talk about this subject?
Mir, I would definitely want to agree to this fact that people have had a very better experience in unit linked, especially to the people who have bought this kind of product before 2012. So before 2012, if you see the charges, the initial cost in the products were very, very high, starting from a 20% to as high as 80%. And these customers have had a very major loss, and till the time they got back their money till 2017. So the customers who have invested their money in this period of time would have not had a very good experience. But as a financial advisor, as a financial planner, I keep recommending my customers this product after 2012, because if you see, IRDA has drastically chopped on the cost and has restricted the overall cost to a maximum of 2% over the period of 10 years. Now this becomes very, very interesting for an investor to see, because it will be at par with any competition product, maybe it be brokerage of direct equity or an expense ratio of mutual fund. So the cost becomes at par. So now when you see this product, this product has become very, very beautiful for someone looking at a larger horizon of investment. And also at the same time, there is an internal flexibility of switching anytime from equity to debt, coming back from debt to equity without facing any cost, without facing any income tax liability. And at the same time, you have an insurance cover. The maturity is tax free. A big bunch of benefits that comes with this product. The only thing that is new now is that the cost has become at par, which I believe a lot of people today, a lot of investors today are not aware of, because of the kind of bitter experience that they have had in the past. They avoid understanding about it anymore.
Okay. So, since you touched upon the tax kind of the angle, can you just, because a lot of people, as I said, are new investors, can you tell what is the exact kind of taxation which people incur on these three products, the direct equities or buying shares directly, the mutual funds and the equity mutual funds and the ULIP? So, what is the kind of tax structure for these three products? If you can explain in brief.
So Mihir, so now the short-term capital gain continues to remain at 15%. If you have invested into a equity mutual fund or in direct equity, and if you exit before 1 year, that forms part of your short-term capital gain, and you are liable to pay 15% tax on the gains that you have done. If your investment into direct equity or equity mutual fund is for a horizon of more than 1 year, it can be any year, it can be 10 years, 15 years, 20 years. More than 1 year will form part of long-term capital gain, and the tax would be 10% on the gains that you have had. So broadly, the tax structure for direct equity and mutual fund is the same. Unit linked product, if you have an insurance cover of 10 times of your premium, which broadly every product has, your maturity that you are going to receive will completely be tax free under section 1010D. So you are not liable for any tax under the Income Tax Act.
Okay. So again, just to summarize this, both in case of equity or equity mutual funds for a long-term kind of a product, right? They would fall under long-term capital gain. Uh,
True.
and in case of unit-linked products, the maturity gains would be tax-free under the section 1010D because it is an insurance-based proceeds. Am I right?
Exactly. Yeah, that's correct.
Perfect, perfect. So this is the tax angle kind of. Now, can we talk about the from again from all these three products? Can we talk about how does the investment decisions happen? I am sure specifically with regards to mutual fund versus unit linked products and versus shares. Every time you're buying it, the fund manager or you yourself take the investment decision. So how typically the decision of the fund manager varies from product to product?
So if you see, Mihir, direct equity, the decision is something that you make on your own instinct. Okay, you might see an CNBC, you might see a money control, you might have a friend who is doing equity who may recommend you. You may do your own study basis which you would want to buy. So direct equity fundamentally is something that you choose, you make an investment decision while buying the share. When I move to a mutual fund, there is a professional fund manager who would want to outperform the benchmark, who probably would want to go for a high beta investment. Maybe he wants to be a little aggressive, or someone would want to be conservative. So there is a professional fund manager who looks at the long-term story of an equity and would also see what are the fundamentals, what is the management of the company, So typically there it is more of understanding the company and then picking and taking an investment decision. In a similar way, when you go to a unit link product, the identification of equity is very, very similar. There's a professional fund manager. The fund manager would look at a lot of aspects. One differentiator between a small differentiator between the mutual fund and the unit linked choice of equity would be that the insurance company would look at a little longer horizon of investment, which probably the mutual fund would not look, because there is a choice of the customer liquidating the money at any given point
Yeah.
of time.
So liquidity
And
pressure is.
also, yeah, and also there is no commitment of future inflows, which is not the case in a unit linked product. There is a commitment of future inflows. So the decision making of the fund manager becomes a little better, where he knows that he will be able to buy more equities. He's going to get a larger flow of money in future, and his horizon can be a little larger, and hence it is a little safe. If you see in a choppy market, the unit linked plan will perform a little better than mutual fund, and in a rising market the mutual fund will perform a little better than unit linked. In short term, this is a little plus minus that keeps on happening. But the investment decision in a mutual fund and the unit link is majorly on the fundamentals and the long term growth story of the equity or the company.
Uh, Sanjay, just a second. Anybody, if you have any questions specifically, please you can type in the chat box. We would be taking questions as and when we can find time in between, or maybe towards the end of the session. So I would request everybody to type your questions. Okay. Next question, Sanjay, which I would like to ask you is, see, at this level, 47,000 level of Sensex, a lot of people are still sitting on fences. They have not made up their mind whether the market will go up, and should I invest now, or the market is already heated up and I should exit now. A lot of people are sitting on the fence, yet to decide. And plus, a lot of people are today opening a lot of demat accounts. In fact, just a few days back, I read that there are around 35 lakh new demat accounts which got added over last 2 months itself. That's a huge number. That's a number
Yeah.
equivalent to last entire year's demat accounts opened. Okay, so a lot of people want to start trading in stocks, and maybe they feel that they have already missed the bus, kind of. So what would you recommend to these kind of newbie investors? Whether is this the right time to enter into to start a demat account and start trading? Because every day I keep on getting one or two new clients who keep on asking, I want to open a demat account, I want to start trading. What is your viewpoint on this?
Mihir, I would want to use this term FOMO. That is the fear of missing out. I think most of the times I have seen, especially when the market is rising and is moving towards one direction, especially a lot of investors tend to say, yesterday I saw an ABC stock at 100, today it has become 110. If I would have invested and 1 lakh rupees, I would have earned 10,000 rupees today in just such a short span of time. And this same investor, when he actually enters the market, Burger King in the last couple of days is an amazing example. An IPO that was at 100 rupees, at 60 rupees, opened at 108, 25% up, again a 20% upper circuit, again a 10% upper circuit. And the last 2 days, we are seeing the people who just entered, expecting that let us earn a quick 10-15%, are all stuck and are not able to sell, because the stock is gone to a lower circuit of 10% continuously for the last 2 days. So I would say, have an investment goal, have an investment ideology, and invest for that ideology or the goal. The product that we are talking about, let it be equity or a mutual fund or a unit link, is just a vehicle for you to achieve your goal. So I would rather say let's not get greedy and fall and get stuck into an investment and then blame the equity market altogether. If you just plan your investment well, and if you are investing for achieving a goal, I feel that the investor will be more happy and will not be worried about a short-term equity volatility. Talking about Mihir, the investors that are still wanting to make a decision sitting on the fence, I would say if you are already invested and if you are looking at is this an high or there is something more to come, my recommendation to them is that if you are wanting to book profit in a short horizon of 1 year, 18 months time, you can partially a 15-20% booking can be done. If you are wanting to invest for a long term horizon, you can begin from here, because as I initially started, the long term outlook of the market remains positive. There is going to be a huge opportunity for our country, and the market is going to do extremely well from here.
Okay. So in that case, should somebody look at a SIP or a systematic kind of a investment, or he should just dump everything in a lump sum? What is your viewpoint again over here?
I think, Mihir, if you have a lump sum money, go for an STP kind of investment when you park into debt, and over the period of time in 12 to 18 installments or 24 installments, you enter into equity, or do an SIP. A lump sum into a direct equity at this point of time would not be my recommendation.
Okay. There's one question which has come, which I would like to take from Rupali. She's asking that she's a 24-year-old person. She wants to know whether she should invest into shares or into an LIC policy. How would you? There's a different kind of a question, but how would you tackle it?
Mir, I would say that investment is more about discipline than returns. And the kind of investor that we are talking about, a 24-year-old, I would say she should opt for an disciplined investment, a committed investment, which would be an insurance product. Not naming the company LIC or any other insurance company, but maybe to begin with, I think she should or he should begin with savings, build a discipline of investment, and then steadily move towards other kind of investments.
Yeah. So
I hope I'm out, Mihir. Am I? Are you able to hear me?
yeah, very much. I think you are. Anybody else, if he's facing problems, please mention on your chat box so that we will come to know. So coming back to your answer, Sanjay, when we're talking about disciplined investments, what I think he's trying to say over here is that you keep on investing on a monthly basis or a weekly basis, whatever it is, so that your money flows from your account on a regular basis. That is very important. So that you create a corpus at the end of a particular period, right? So next question which I would like to take over here is, what are the various options today available when it comes to ULIPs and mutual funds? I'm sure there are a lot of products and a lot of companies present in this space. So how do we select options within this space?
So, Mihir, I think this is more of the kind of product that you choose. So into mutual funds, of course, there are many funds. I would say more than 1,000 funds available. To begin with, I would say go for a top 10 fund house, and avoid going for IPOs. Try to go for a fund that is more than a decade old, because there is an experience of investment, and there's a performance of the fund, and an history of the fund. So for new investors, I would recommend in mutual fund go for something that has a performance history. Coming to ULIP, Meher, I would say just look at a good distributor who would service your product, because unit linked is a product that can outperform the benchmark, outperform any investment if the distributor has serviced the product well. Because looking at the performance of the equity, looking at the market, You have to keep switching from equity, come to debt, come out of debt, enter into equity. If the market is gone up, book a little profit, because there is no tax issue. Most of the time you are not able to liquidate money from your mutual fund or in equities because you'll end up paying tax. So rather let the market fall 10% instead of paying 15% tax, which is not the case in a unit link. You will be able to get the advantage of this 10% without maybe incurring any tax liability. So I would say for a unit link, forget the company, go for a good distributor,
Okay.
which
Okay.
I'm sure Smartwealth is.
Thanks. Okay. So when you are talking about switching from equity to debt and all, can you elaborate this point? Because if you can throw some more light, we would understand what exactly you're trying to say over here.
So Mihir, this I would want to link with your previous question when you say that what do the customer do? The ones who are sitting on the fence, who do not know what to do. So assuming if you have 100 rupees invested into an equity, okay, and you decide to book a 25% profit, you withdraw this 25%, but what do you do with this 25% now? Either you park it in a bank, or you make a fixed deposit. In any situation, the question is, what do you do with this money now? Because you do not need that money. You are taking this money only because the market is gone up. Now, in a unit linked scenario, the moment you switch the fund from an equity to debt, you have booked that percentage of money. The profit is already booked in your account. Okay,
Okay.
and the money is parked in your debt, which is also growing at a rate of 7-8% of whatever is the return that debt fund is giving. So you do not have the issue of, give, I take the money and what do I do with that money? So in a similar manner, if suppose you are wanting to invest now, so and if I have 100, so what do I do with this 100? I park the entire 100 into a debt, and then just switch 20% out of it from a debt to an equity, so that if the market rises from here, if the 47,000 of Sensex becomes 60,000 of Sensex, this 20% of your money is parked in equity and is giving you some kind of returns. And in a similar vice versa. So switching is booking profit if you are in equity, and investing money into equity if you are in debt. And this, the beauty of this is, Mihir, all of this can happen over a click of a button. You have to do nothing. If you sitting at home, if you want to do it, it just takes 1 minute. You can log in on whoever is your insurer from whom you have bought the product. Log in on the site, or a click of a button, your money goes from one fund to another fund.
Perfect. That sounds interesting. Uh, so one question which we have received on the chat is that, say, if I have been earning good profits on shares, okay, still should I look at investing in mutual funds, or should I continue to stay invested in shares directly?
May completely would depend on the horizon. If suppose if you have a 10-year horizon of being in that equity, no harm, stay back in that equity, book certain profit if you have booked a profit, because I am of a belief that the money that you take back home out of the equity is the money that you have earned. Rest all is just a number. So book a little profit, and depending on the horizon, if the horizon is short term, book larger amount of money. If the horizon is long term, if you do not have the curiosity to see your portfolio every day and get excited about either it going up or going down, you can take the decision of your investments.
Okay, good. Viewers, again, would like to remind you that if you have any specific questions or queries, would request you to put them in the chat box so that we can take your questions. Sanjay, next question which I would like to ask you is in terms of uh, uh, in terms of mutual funds specifically, there are various options like small cap, large cap, mid cap funds, etc. Are these kind of options also available in Ulips, and how these options can be serviced by anybody?
Yeah, so Mihir, as I said, that for the choice of fund, the investment opportunity in both mutual fund and unit link is very, very similar. You have mid cap funds in unit linked. We have mid cap funds in mutual funds. You have large cap funds in both the places. You have multi cap funds in both the places. So all unit linked plans, if this is your question, that will unit linked funds also have a multi cap or a mid cap kind of fund, the answer is yes.
Okay. And in terms of shares directly, a lot of new platforms are coming up. Okay, trading platforms. So, what is your view about these kind of trading platforms? And should a new investor, a retail investor, look at investing through direct online trading platforms? In fact, one more point which I would like to which has come to our notice is a lot of investors are getting a lot of phone calls specifically from unknown people suggesting investment tips and asking them to trade specifically. Trading related portals are asking people to open up accounts. How risky or how serious this kind of trading could be? So, if you can throw some light on this.
Mir, I will give you a very interesting statistics for this.
Okay.
Of how can you maybe influence an investor,
Hmm.
assuming you have a 1 lakh name and contact number. You have a database of 1 lakh people,
Hmm.
okay, and you for 50,000 people you send a message saying that buy Larsen and Toubro stock, and the other 50,000 people you send a message saying that sell Larsen and Toubro stock.
Okay.
Either of this bucket is going to make a profit. Okay, assuming the stock went up. Now ignore the 50,000 whom you said that you have to sell. Now focus on the first 50,000 where you have gone right. Now send them a second message. Divide them into two buckets, 25,000 and 25,000. For 25,000, drop a message saying that buy ICICI Bank. The other 25,000, send a message saying that sell ICICI Bank. Now again, you have to get right. Either the market stock has to go up or it has to go down. Now, assuming this time the stock went down, now ignore the 25,000 whom you said that the stock is going to go up. Focus on the other 25,000, right? Now divide them into two buckets, 12,500, 12,500. Send them another message of maybe take any company, right? Maybe HDFC. Okay, for one you have to say buy, the other you have to sell. You have to say sell. Now just imagine after doing this practice, you have 12,500 happy customers to whom you can call and say that I have given you 3 tips in the last 3 days and all of them have gone right. And if you would have invested 1 lakh rupees today, you would have been at 30,000 profit. Just imagine the kind of risk that the investor can be at. So I would say just completely avoid such phone calls, such messages. This will give you a long-term loss.
Thanks. That's a very interesting example which you gave, and I'm sure a lot of people have been experiencing. In fact, I would have got at least 2 to 3 calls this particular week itself. So that's the number of calls which people are getting. One more interesting question which has come up is what is the basic difference between a term plan and a unit link plan? I think somebody has asked that. So if you can throw some light, and can I ask you a follow-up question also in this, because that's I'm sure somebody will come up with that. What should I buy? A unit link plan or a term plan with a mutual fund?
So Meher, I will tell you, this question is like, should I have lunch or should I have dinner? Right? You should have both. So term plan is typically to safeguard your family. Okay, if you really love them, you should definitely buy. And term plan is something that I think no one can ask whether I should have or I should not have. If you are earning, you should have. There's no discussion. And coming to a unit linked is more to do with investments. So if after securing your family, you have more money which you want to invest and which you are expecting to grow, you should definitely invest into a unit linked investment, because term plan money is only for security and it is not an investment. And unit linked is typically an investment avenue that you can choose as your vehicle to achieve your financial goals.
Okay. So my follow-up question was with regards to term plan plus mutual fund versus unit-linked plan. So how would you like a lot of my clients prefer that kind of option over buying a unit-linked plan. So how would you like to answer that?
Mihir, I think we have answered in bits and pieces this in our previous conversation of last 30 minutes. But just to summarize, I would say buy all three. Okay, buy a term plan because you want to safeguard your family, you want to safeguard your future earnings. Buy a mutual fund because you would have some or the other short-term goal in your life that you would want to achieve, which comes in 2 years, 3 years, 4 years, 5 years. Make some investment into a mutual fund that can give you aggressive growth and short-term liquidity also. Buy a unit linked plan, very important, that will set up a long-term corpus for you and will give you money exactly when you need it. So there are certain goals that you cannot skip me here, like a retirement. At 60 you have to retire, and at that time you do not need gold, you do not need house, you need money, you need cash flow, right? So you have to buy an investment that will give you a corpus or a regular income at that age. A child education or a child marriage or some or the other, these goals are something that cannot be skipped. And for such goals you have to have a plan which you cannot exit. It is like self discipline. If you know that you have a 5 lakh rupees and you want to go to a holiday to a Europe, you know you can take that money today. And if you can take that money today, why not have a lavish life today? For tomorrow, let us think about tomorrow. But that's not how it works. What you are earning today has to take care of you today, and the same money has to take care of you tomorrow also. So I would say that do not pick and choose, मैं ये करूं या ये करूं. Go for all three.
Perfect. Thanks, Sanjay. Viewers, we have been posting links of our YouTube channel where we have posted a lot of finance related videos. We would request everybody to click on those links and hit a like or subscribe to our channel. Also, if you subscribe, you would get timely updates from with regards to various finance related questions which you have been trying to answer. Okay, so coming to my next question, which somebody was asking is, what is the kind of minimum investments which somebody can invest in products like mutual funds, shares, and unit link plans? So, what are the limits for the investments?
So, Mihir, I think someone can begin with a 1,000 rupees also. So it depends on the amount of money that you are able to shell off every month or every year. I believe mutual funds can be done, and SIP can be done starting from 500 rupees.
500 rupees, yeah, at 500
yeah.
rupees.
A unit-linked plan can be bought maybe with 2,000 rupees per month of investment. An equity share can be bought even if you have 100 rupees in your account, and if you feel that there is a stock which is at 20 rupees, you can buy 5 shares if you just have 100 rupees in your account. So there's no minimum kind of thing. It is just that where you want to reach, and if you want to reach a certain place, how much you have to invest. So you have to invest basis the amount of money that you are going to need at certain point of time. If you want to go to an Oxford, you cannot say that I would not shell off more than 50,000 rupees.
Okay, what are the common myths about equity investments? Because we will talk about equity in general. A lot of people are still afraid entering equity as an asset class. If you can throw some light about and they may not enter either of these three instruments and feel that मेरे लिए तो FD सबसे अच्छा है, मेरे लिए gold सबसे अच्छा है, or somebody may park in real estate as well. Okay. So, what are the common myths about equity as an asset class, or these three asset classes all put together in a single bucket?
So, Mir, I would first tell you why this myth, right? If you see that equity is 95% people paying to the balance 5%, because only 5% make profit. And I think that is the reason why this myth is, because if you randomly check with 10 people around you who have invested into indirect equity, you realize that all 10 have made a loss, and you feel that you would be the 11th. Okay, and only this fear of losing the money creates this kind of myth. I think the biggest myth is that if you enter equity you make a loss. I think the biggest myth is that equity में immediate पैसा profit हो जाता है, and that is why people choose direct equity compared to mutual funds or a unit linked kind of investment. I think all three are very, very good investments. I think all three are the kind of investment that can give you the best CAGR returns compared to any other investment avenue.
I think one more point which I would like to add over here is basically the greed to make quick buck, quick money is what a lot of people think equity as an asset class where I can make quick money and run away with that.
Well said, well said,
That
yeah.
is actually a myth, I think. Thanks for a wonderful answer, Sanjay. One more question which has just cropped up. Just a second. Okay, so would like to know what are you highlighted a lot of positives about Ulips. Okay, are there any negatives which we should stay away from, or something which people should stay away from?
One thing that I would definitely want to highlight, and I see that a lot of customers fall prey of this thing. That unit linked is a minimum 5-year commitment. So if you come across anyone recommending you a unit linked product for a less than 5 years and saying that you do not lose any money, the money goes into a discontinuance fund, it still earns profit and gives you maturity, I would want to highlight that such policies are taxable at the time of maturity. So you should enter into a unit linked plan only if you feel that you would be able to pay off the premium commitments for a horizon of 5 years minimum.
Okay.
You should always see that the cost is competitive, which majorly with all products are. But then there are certain products which are really very, very good, which you should be able to identify. And the third thing, as I would again repeat, and I'm a very strong believer, go through a very good distributor when you're buying a unit linked product, or maybe any other equity product.
Okay. One question which comes to my mind is while finally whether it is unit linked product or whether it is mutual fund, how do we select a good company? Which company to invest into? What are the factors that we should be looking for while selecting a good investment house, basically an asset management company in case of mutual fund, or an insurance company in case of a ULIP. So how do I select a good corporate?
I think this should majorly basis the fund management team, the company investment philosophy, and of course the performance of the fund in the past. I would say, and when you're seeing the performance, you should definitely see the beta of that fund. It should not be that some fund shows a very high returns in a horizon of 1 year and 2 year, and you realize that the beta is very, very high. So if the beta is high and the performance is good, I would say that that is not the good way of factoring the performance. Anything above a beta of 1 is something where the risk is high, and that is why the returns are high.
Okay. So in terms of, I would like to add a point over here is whom, through what distribution channel you are buying. That also plays a very important role.
Most important here, most important.
Yeah. So what kind of advice you are getting before investing also becomes a very important factor over here. One question which has come up is what is the right age to buy a ULIP, and for what maximum time horizon?
Younger the better. When we talk unit linked, I would say younger the better. That does not means that people in the age group of 50 plus cannot buy. They can buy. There are other ways through which you can buy a unit linked option. But in the age group of 0 to 50, I would say your horizon might differ. If you are 50, you should take a 10-year term. If you are 30, you should take a 15-20-year term. Go for a longer horizon. No point in investing if you are 35 and if you're investing for a 5-year horizon, what do you do with that money at the age of 40, unless you have some commitment, because you are going to be earning. You are not sitting at home at the age of 40. You have cash flows, you have money coming in. What do you do with that money? So plan your, the way you plan your investments, also plan your maturities, that when do you want that money, how do you want that money, and what is the purpose of that corpus that you're going to have after you receive that money back.
One interesting question which has come up is I'm currently in the highest tax bracket. Uh, what is good for me? Whether a mutual fund, whether a ULIP, or whether buying shares directly. So,
I have answered this, Mir. Unit linked is the answer, because it earns you tax-free money.
okay,
The avenue is the same. The investment fundamentals are the same. Tax is the additional gain.
perfect, perfect. And can a minor see a lot of people I have seen investing in the name of minor child for unit link plans specifically that gets pushed around. So, what is your view about this? Should a minor invest a minor child be the life assured in case of insurance plans?
Mir, in case if you are completely secured in terms of your insurance, you
Hmm.
can do it.
Hmm.
If not, then definitely you should take an insurance in your own name.
Okay. And how about from a pure insure? If I'm doing that pure investment, I'm doing that investment looking at only the investment angle and not at the insurance angle.
Then you should go for buying an insurance on the youngest family member in your family, because that will earn you the highest returns.
Okay, perfect. Uh, One more question which has come up is: can we get any loan against shares, mutual funds, and ULIPs?
Uh,
Yeah,
I believe yes, Mihir. I think you can get loan from all the three avenues.
yeah. So
Percentage might differ,
yeah.
but you can take loan from all the three
Yeah,
avenues.
I think there's something called loan against securities, which is also known as LAS, and you can definitely avail LAS as a product from any of the bankers or non-banking financial companies, and you can approach your financial consultant for the same. So just a second, let me check if any other question has come up. Okay. You said about the myths about ULIPs. I just want to know, are any such prevailing myths about mutual funds? I'm sure government has been advertising a lot, mutual funds sahi hai. What do you think are basic myths about mutual funds?
Uh, so Mihir, I would only say that while mutual fund sahi hai, and there is a lot of advertisement about going for direct investments in mutual fund, all of those, I would say that unless you are completely aware and you are able to service your entire investment, you should go for it, or else prefer going through a distributor who can service you, who can guide you, and who can recommend you, continuously recommend you of where your investment should be parked. I believe certain myths that in a long term this may not give profit if the market falls, or in a short term it may give profit. This is a common myth about all equity products, irrespective of direct equity or a mutual fund or any other equity based investment.
Okay. Uh, One question which has come is how does I'm sure you being a certified financial planner, how does a CFP or a certified financial planner works against Indian investor mindset? Is an advisor important, and what is his role per se, as per you?
Uh, uh, the goal of the financial planner is what you are trying to ask me.
Yes, yes. So how important is a certified financial planner like you important in today's scenario, or rather in any scenario? And what kind of role an advisor plays specifically?
So, Mir, for a simplest thing, if you go for a 1 hour gym, you try to have a trainer so that you do not do anything wrong. Okay, it is out of the 24 hours, just a 1 hour exercise that you do, you prefer having a trainer who can guide you. Yeah, I think CFP plays a similar role. He will continuously construct a plan for you, maybe guide you of what kind of risk that you should take. How do you decide your horizon? How do you make your cash flows? How do you create an emergency fund? How do you secure your family's life and health and the critical illness that might come? So I think very important. Globally, the awareness is huge, and you will see in all the first world countries the demand for financial planners, educated financial planners is very high, and India is steadily adapting. Is my experience in the past few years.
What is the difference in, since you're talking on this subject, what is the difference in the global established markets like the Americas versus the Indian market in terms of financial planning and financial advice?
I think the literacy of having a financial planner globally is very high, and in India we consider that as a cost. I think here my experience is that people prefer paying indirect cost instead of a direct cost.
Okay.
So instead of if I say if the cost of a financial construction of a financial plan is assuming 25,000, you will end up paying a lakh of rupees by buying a wrong product, just to save this 25,000 that you would have paid to the financial planner for construction of the plan and review of the investments that you keep on doing.
Perfect. So I think we have got a lot of questions. If anybody wants to ask any more questions, I think we have already crossed our time limit. So if you have any further questions, please type it while we take one or two last questions. Okay, so in this volatile market like this, what is better? Because again, whether shares, mutual funds, or ULIPs, what would you say?
Mir, my answer remains the same. Depends on your horizon. If you have a short-term horizon, do not go to equity at this moment of time. Short-term might look very good or very bad. If the horizon is long-term, just enter into the market at any given point of time. My second suggestion is that be a regular investor. Just equity is not a place that you just got a bulk of money from somewhere and just put it in at one go. Equity is a product, either direct equity or a mutual fund or a unit link, whatever. These are just names. Okay. I would say that a regular investor, and even you, Mihir, in your career of financial planning, would have realized that people who have been regularly investing, irrespective of the market going up or down, have always been very gainful, and are the ones who would have definitely made returns over the period of time. But if you enter the market today saying that I want to earn tomorrow, I want to make a profit in 2021, or I want to make a 30% profit by 2022, no, this is not the investment avenue for you.
So Sanjay, let me ask you one last question, okay, which I get every now and then. कि मेरे पास पैसे है, कोई एक शेयर बताओ जिसमें पैसा ना.
Yeah, I think this is the kind of question कि कल market क्या लगता है. I think जो भी बता रहा है वो झूठी बता रहे हैं, because market क्या लगता है वो तो जब market खुलेगा तब पता चलेगा. What I am telling is just my point of view, and that has nothing to do with the actuality of the stock market. So as you said, everyone wants to make a quick money, and
wants to know one magical tip so that they can make
which is not there, and if it is there, you are just lucky to have that one, and it is once in a lifetime opportunity.
Perfect. So I think we are done with most of the questions. Thanks a lot, Sanjay, for taking your valuable time and helping our investors with your wonderful insights. Thanks a lot, everybody, for joining in. You can visit our YouTube channel. You can also subscribe to the channel. And once again, thanks a lot for visiting here today.
Thanks, Mihir. Thanks to the entire Smartwell team for calling me here. Thanks to everyone who was part of this call. It was really a privilege to be here on the platform.
Thank you, everybody. Thank you.